All right, okay. Thank you for including our paper to the program. So my name is Xiaoxia. I'm from University of Delaware. This is joint work with Ken Fruit, Gideon Ozick, Ronnie Sadek, and Si Chen. So the title of the paper is Media Reinforcement in International Financial Markets. All right. Media, well, I think we all can agree, or at least the people in this room can agree that media is an important avenue for information dissemination in financial markets. So every day, the media writes about financial markets. People read it, and they're trying to process and digest it, and they're trying to make sense of what it is. Is it noise? Is it fake news? Is it genuine information? And trying to take the information in their investment decisions. In the recent years, the topics of AI, machine learning, and natural language processing have become increasingly popular. So now we have new technology and the new tools that allow us to better capture and analyze the media data. So right now, media research is really a good place to be right now for academics like me. So a lot of work has been done in this area. Typically, academic research is primarily focused on the direct effect. So what do we mean by direct effect? So for example, take the sentiment analysis. People can look at the words that take in the media article, look at the words and maybe bags of words, use various natural language processing algorithm to quantify the tone of the words. Okay, and they have a measure of sentiment, and then they can look at how the media sentiment can predict stock returns or maybe other economic variables such as future earnings announcement and trading volume. So yeah, those research tend to extract media data from, let's say, traditional newspapers, traditional media outlets, and they tend to focus on individual stocks or maybe U.S. aggregate stock market. So in our paper, we're going to do things a little bit differently. First, we're going to extract media from many source types beyond the traditional newspaper. And we're going to look at, instead of a direct effect, we're going to try to look at the interaction effect between media and asset markets. And we're going to try to show this effect across several asset classes. So we're going to look at the individual stocks. We're also going to look at the country equity and the currencies. And I'm going to show you this effect, this interaction effect occurs in all these asset classes. So the fact that we found this effect across these asset classes, I think is very comforting because that says about results are probably robust. But the thing, think about this new age of big data is that typically we're dealing with a very short time series. We don't have a long time series. So when you have something, how do you know? How do you convince people, and including yourself, that your results are robust? So our idea is, okay, let's look at, let's expand our cross section. Let's look at other asset classes, not just individual stocks. All right, so what do we exactly do in our paper? We're going to study the interaction between media and asset prices in this context of a short-term reversal phenomenon that's documented in many asset returns. So what is short-term reversal? It refers to the tendency of recent past winners to underperform the past losers in the cross-sectional asset returns. So this phenomenon tends to occur at short horizons, such as monthly or weekly. And what is the driver of this of reversal? And typically people say it's caused by overreaction on the investor side. So the question here is, okay, how do you measure the amount of overreaction in asset markets? How do you measure the investor sentiment? Now, asset price, of course, is a good indicator, because if investors are optimistic about an asset, for example, about a firm or a currency, they can go to the market and buy the asset. So the asset price is going to go up. So since we can observe the asset prices, so you can interpret the rising asset prices as an indicator of optimism. Now, what we're saying in this paper is that, well, we can also look at the media. Okay, look at what media has been saying about the asset. If the media is also optimistic about, if the media is also optimistic about the asset, that's also another indicator. We can use two indicators. And the main hypothesis we have in our paper is that when these two indicators agree, Okay? So for example, if the asset price has gone up in the last week, and then we look at the media, if the media also has been optimistic about the asset, then we'll say we're in a situation of excess optimism, which means that it's going to be followed by price drops. On the other hand, if the asset prices have been low, and you look at the media is also pessimistic about the asset, then we say this is a situation of excess pessimism, and that's going to be followed by price reversal. So our main hypothesis is that when media and the asset prices agree, okay, you're going to see a stronger reversal. And this graph here captures our main hypothesis. When these two indicators agree, you're going to see a bigger reversal. Now we call this effect a media reinforcement effect. And we're going to try to show this effect in individual stocks, currency, and the country equity. This paper, of course, is related to a large literature. And of course, most important is related to this growing literature about the role of media and its impact on asset prices. It also speaks to some of the traditional finance topics, and I'm going to skip that. Let me introduce you to our data. So for the rest of the talk, I'm going to spend a few minutes talking about the data and how we construct our measures, and then I'll move on to talk about our empirical results. So the data, okay, we collect our data ourselves. So we build this technology to tap into thousands of sources on the internet. And as I said earlier, we collect data, media articles, not just from traditional newspapers, okay, the general media. We also collect articles from specialized media. We also look at what corporations are saying about themselves. So like the press release. We also look at the news wires. And in addition, we also look at some social media sites. So we think it's important to extract media data from those many source types, because investors learn about financial markets not just from traditional news media. So it's important to look at all source types that investors are actually looking at. And so we collect data from 14 developed countries and 17 emerging countries. And we collect the media articles about the currencies and the country equities. So let me give you some summary stats. So on average, in our sample period, so we have a short sample period from 2013 to early 2017. And on average, for each currency and the country, we have about 10,000 articles in our sample period. And if you look at the top right graph here, you can see that that distribution is kind of skewed towards the large countries, such as US and the UK, so that's not surprising. And we also collect the media data about individual stocks, mainly for US. So we have the longest time series for S&P 500 stocks. So that's what we're going to use in our paper. But we start collecting non-S&P 500 stocks and as well as international stock recently. We actually also collect the data about commodities, and we have done something with it, but these results are not included in this set of the slides. All right, so for each article in our sample, we try to assign the sentiment score. Again, we have tried various NLP algorithms to quantify the sentiment, and we found that our results are not sensitive to which one we use. So in this paper, we use a very simple, following the literature, use a simple sentiment measure. Basically, we count how many positive words in the article, how many negative words, and then you calculate the difference, and then divide by the sum of these two. So the measure is in the range of -1 and 1, 1 being very positive. Okay. And now, when we were looking at the data, we actually saw a lot of fixed effect. So for example, if you look at the coverage about SP, for US stocks, you're going to see some kind of local bias, okay? And then we actually also saw some kind of auto-fixed effect. So there are a lot of fixed effects. And in this paper, we do a simple adjustment. So for each asset, okay, for every day, we aggregate all articles about the asset and then calculate the average sentiment of the asset. And then we do a simple adjustment. Basically, we'll look at the past 4 we look at the past 4 same day of the week and we calculate this historic average of this asset, and subtract the benchmark from the today's sentiment. So our daily sentiment measure is essentially a sentiment change. It's an abnormal measure, a measure of abnormal sentiment. Now, before I move on with the pricing test, let me show you some graphs. Okay, tell you how our sentiment measure turned out in some major events, just to make you feel comfortable about our measure. So the 3 events I'm going to pick, they are all political events, okay, but we're not making any political statement. The first one is the Brexit. All right, so how do we understand this figure? So we have top panel and the bottom panel. So that's the one up on the top is before the event, and below is the after the event. So below and after. In terms of the color spectrum, green means it's positive, and the red is negative. So leading up to the event, you see more green on the top one. So it means that the media sentiment about the country equities on average are positive. But when the leave was announced, the global sentiment turned negative sharply. So look at the a lot of red color there, with maybe 2 exceptions in Russia and China. So that's one event. I'm going to show 2 more. Okay, I'm going to show you the U.S. presidential election not last year, like 2016. So top. Also, by the way, this is about sentiment about the currency. So the U.S. there is empty because it's all currency pairs, all relative to the U.S. dollars. So the sentiment before is, we see more green color is on average is positive, but then we see more red after the election. So of course, there's always a few countries with exception, for example, Russia. I'm not sure where Turkey is, but that's our data. All right. Okay, how about one more example? So this is the French presidential election. This is, I think, after the first round. And this is an example of showing how our measure reacts to a positive media event. So you see more red after the event. Okay, so hopefully I've convinced you that our measure does capture some sort of media sentiment. And what I'm going to do next is I'm going to take this measure and run some mass pricing tests. And our main empirical methodology involves a portfolio approach. It's a calendar portfolio approach. I'm going to start with something simple. We're going to do a single sort based on past returns. So our formation period is a week. So basically, we're going to sort our assets in each asset class. We're going to sort our assets based on their return in the last week into winners and the losers, just 2 groups. So we're going to calculate the return, the performance after that. And our holding period is 10 days. So if you calculate the return between past winners and the past losers, that return spread, if that return spread is negative, that suggests reversal. And then in our paper, what we do is we're going to add the media sentiment. So we're going to do a double sort, a deepen double sort. Basically, within past winners and the losers, we further sort the assets into in high sentiment and the low media sentiment. So you're going to have 2 by 2 4 portfolios, okay? And we're going to track the return in the next 10 days. And as I mentioned earlier, our sample period is from 2013 to 2017. And now let me show you some of our main results. So I have, let me help you how to understand this table here. I have 3 asset classes: FX developed, country equity, and the large stocks. Large stocks is the SP 500 in the United States. Let me start with the reversal, the row. Let's see if I can point. Okay, let's see this number, okay? Negative 2.9. That number is the return spread between past winners and the past losers, sorted just based on their return in the last week. This is a currency. So this number, by the way, is all annualized, okay, annualized. So the return spread is negative, suggests that there is reversal in this asset class. Now, what we want to show you in this paper is that this reversal, you actually observe stronger reversal when the media sentiment and asset return agree. Okay? means that, for example, this is a low, low, okay? If a currency has had a low return in last week and the media sentiment is also negative, then you can expect to earn about 2.04% in the next 10 days annualized, okay? And then if you look at the high sentiment and the high return, then you're going to experience negative 1.72% return. So the reversal here only occurs when the media sentiment and asset prices agree with each other. So if you create a strategy, not a unconditional reversal strategy, if you actually buy low, low here and short high, high here, all right. I'm talking about the reversal, so I'm not thinking about the strategy yet, how to make money yet. So let's think about the negative number here. What is this negative? This negative number means that if you do this, okay, buy this and then short this. So the difference between these two is negative 3.76. This number is higher than this simple one-way sort reversal return spread. So that's the key of our finding. And basically, I'm going to repeat the same test, okay, across other asset classes. So for example, if you look at the country equity, if you compare these two, the magnitude almost doubles. And we did the same test using the SP 500 stocks. Again, there's reversal. And then the reversal only occurs when the media sentiment and asset returns go in the same direction. Okay? So this is summarizes our results. Now I'm going to show you a few pictures maybe so that you can see the results better. So here is a similar kind of portfolios. We have 4 portfolios, and this is the event study. So the time 0 here is the time we're in 4 portfolios. Okay? And on the left-hand side, those are the past losers. Here, I think we use this results for US stocks. 2 panels left is the past losers. So this stock had very bad returns in the last week, okay? And we see reversal, but the reversal only exists among stocks that also had very negative media sentiment. So this is the portfolio that the media sentiment and asset returns go in the same direction. So you see much stronger reversal among the stocks. And similarly, on the right-hand side, for the past winners, okay, for the past winners who have the higher reversal, the portfolio that has had very high media sentiment. All right. So this is our results. Now, at this point, you probably are thinking, well, although your measure of media sentiment and asset returns, they are independently constructed. But media and asset market by no means are independent. Okay? Media sentiment can be affected by what's going on in the market. So there could be a feedback effect there. So how do you address that? So one test we did is let's estimate a VR type of model. Okay, so for daily return and the daily sentiment, we're going to regress that on the past media sentiment and the past returns, and then we include 5 lags. So we're basically trying to decompose both the return and the media sentiment into 2 components, the expected one and the residual. So the fitted value from these regressions are expected returns and expected media sentiment. So the error term is the residual. And so this is an estimate on using daily data, and then we're going to again turn that into a weekly measure, and we're going to do the same test we did earlier. Okay, but here we're going to use the expected one first, and then I will show you the results when I use the residual components. So the similar structure for the table, but remember this is using the expected component, expected media sentiment, and expected returns. Now, what's interesting here is that if you use the expected return here, we actually don't see reversal as the returns, for example, FX. And this is actually positive. So instead of seeing reversal, we're actually seeing continuation, okay, momentum. And then there's the reinforcement effect that we talked about earlier. We don't see that in this table. So using the expected component, we don't see the reinforcement effect. Now, let me show you the results when we use the residual unexpected component. So this is when we see the reversal to begin with, okay, when we sort, and this is when we see the reinforcement effect, in the sense that when the surprise component of the media and the surprise component of the return, when they go in the same direction, you see the stronger reversal. Okay, so now you might be wondering, you're looking at these results. They include a lot of days when there's news event, major news event. So this is the days when the media coverage is going to spike. So is our results driven by those major news events? So what we do next is to remove some of the major, for example, for U.S. corporation, we may remove the earnings announcement dates. If there's an earnings announcement in the formation period, we delete that observation. Now for the effects in the country equity, if there's some major macroeconomic announcements, we take those observations out. And the results here again shows that we see reinforcement effect even after remove those events. So this is not limited to the days when you have major announcements. All right, so we actually did a lot more other analysis, additional analysis because of the time constraint, so I'm just going to kind of go over the list, okay? So we have looked at other alternative measure of sentiment, and we, instead of using portfolio analysis, we also look at the cross-sectional regressions, which allows us, of course, to control for other factors and the characteristics of the assets. Now, since we're talking about a weekly return, so as you can probably guess, the risk can't really explain those results, but regardless, we did that anyway. We also look at different types of media. So for example, for the US stocks, we're able to classify if the media is local to the company. And we found that our results is reinforcement effects is stronger if you use the sentiment of a local media. And then we also did some cross-sectional study using the US stocks. Basically, the reinforcement effect. We want to know if this effect varies in a cross-section by firm or stock characteristics. And we have some interesting results. We found that the results is actually stronger for large cap stocks. Now, our sample already is large cap stocks, SP 500 stocks. But then we further separate them into the larger ones and the smaller ones. And we found that our results actually are stronger even among the larger firms. And we also look at the media coverage. So if this asset is highly covered by the media, we also find that the effect is stronger among those assets. Here is this. I think this results for the stock level. And we also did this risk-adjusted returns because so far our results are using raw returns. So we're trying to use control for some risk factors. And we actually have done some research. We're using the emerging markets and the commodities, and there are some really interesting results. But we're not including that right now for this paper. All right. Actually, before I conclude, I want to show one last slide. So, given our findings, okay, how can you make money? So it's actually relatively easy. Remember this 2x2 square. So in each S class, you can do a strategy by what? By buy low portfolios, low media sentiment and the low returns in the past week, and you short the high return and high sentiment portfolios. Okay, and then you can combine all these three asset classes together. So, and then what we did here is we weigh each time series based on the volatility. So the high volatility time series gets a lower weight, and result of this is in this graph. So this is the performance of the strategy that I just described from 2013. And other than, you see this upward trend. So on average, you're going to see a positive profit. And what's also striking here is how smooth this curve is. So which means the volatility is actually not very high for this strategy, which is consistent with the information ratio of like 1.75. Okay? Right, let me conclude. So as I said, in the media, media research is really a very good place to be right now with all this new technology and exciting new data. There's a lot of work that can be done. And in this paper, we're only doing something what we did is very simple. we're trying to highlight this media reinforcement effect. Basically, when media sentiment and asset returns are two indicators that you can use to detect over optimism or pessimism, which is going to allow you to predict when you're going to see a bigger reversal. All right, thank you.